Andrew, welcome back to the show. Good morning. So walk me through what you see as you follow news headlines as closely as anybody else. What do you make of the action this morning? It didn't seem like we were getting much life from stimulus and then this virus news as well. So what's driving what?
Well, Oliver, I think your guest and yourself at the start of the program pretty much outlined it. What you had was a stimulus, which was very well advertised, and the market did start to move a little bit. But, you know, the virus or the mutation of the virus really took over overnight. And at about 6 a.m., we were at our lows. As you said, down 2% in the S&P, you know, the dollar soaring, bonds, you know, the 10-year to, 87.5, 88 basis points, which is good resistance. Now we're starting to back off. The equities are starting to catch a little bit of a bid. They've made back about half their losses. Bonds are starting to give up their gains. We're a little over 92 basis points right now in 10 years. I think ultimately that we'll find out the vaccine does include this current mutation, and I think things are going to start to return. And I think the stimulus package was a good end-of-year thing. Well predicted, should have probably come a month or two ago, but nonetheless it is here. And as many have pointed out, certainly the Democrats, this is a down payment as what we expect out of the Biden administration. So there's going to be a lot more stimulus. The question I have is, at what point does the reverse happen? Now, Oliver, I know you look at markets as closely as anyone. You know, in 2000, this year, you know, obviously when we started to know about the virus in February, the market just got kicked really hard. Mm-hmm. And on March 23rd, when the Fed went all in, we've been rallying ever since. Now the question is, well, if things start to reverse, if the economy starts to do well, and the Fed's now predicting a 4.2 GDP for 2021 and over 5% for 22, and a lot of people think that might be low, will the reverse happen? Mm-hmm. Will the risk-free rate all of a sudden go up? And will the equity markets underperform, even though the economy is starting to come back? That's a question I have. And yes, there's a lot of money on the sidelines to mitigate that, but I'm really concerned that we might see a bit of a reversal, that we've kind of stolen a lot from 21 already here in 2020. So, Andrew, you know, that's a question I have, and I don't have the answer right now.
Well, I like that you bring it up. It's something that we talk about here quite a bit. It's something that I, too, think is a pretty interesting and potentially problematic dynamic, where the market has clearly demonstrated that it's just fine, especially the NASDAQ trade, that it's just fine with bad news still. I mean, it's kind of hard to deny. Even it's not, it's not a quip. It's not like a cute thing. The market, in many instances, does like bad news, as we've seen here, especially for a big cohort of it. Not one side, which is the Russell and kind of the reopening stuff, but the big tech stuff clearly likes an environment here that's been, let's just say, less than ideal. So as we start to recover, does that kind of reverse some of these trends? One of the things I think that fits in with that idea is the fact that we can't really hold a bid into the bond market right now in treasuries, Andrew, where even over the last couple of weeks, we've gotten some weak data, and we see this morning again, the bonds are quick to fade. Nothing has been able to move the 10-year yield out of this channel upwards, and that's despite no inflation. The Fed continue to say they're going to buy and do everything that they can to keep markets satisfied. They're not adding anything more, but it seems like the 10-year yield has chosen its direction, Andy, and for some, they're fine with that, but they keep saying, well, it's never going to take off. It's never going to move. I mean, it seems like the Treasury yield has decided its direction. I mean, nothing has been able to push it out of this range. What does that mean?
Well, what you have, Oliver, you've got a lot of cross currents, as you said. You had the huge uptick in COVID cases, which is putting pressure on rates to go down. And yet you have the Fed was very clear before their meeting, when you had someone like Kaplan actually brought up the word tapering. And even within the Fed meeting itself and in Powell's press conference, he said nothing about really increasing the amount of buying. And he really didn't talk about yield curve control either. So you know what, the people, the bulls, are going to have a hard time getting through that. And yet we know there's going to be a tremendous amount of supply coming. You know, we're going to have an infrastructure. We have this $900 billion stimulus that we're signing today. We have an infrastructure that's probably going to come sometime in the middle of February, probably in the order of $2 trillion. There's going to be more and more and more spending. So I do think bond prices are going to break. I think inflation's going to break all to the higher, and I think we're going to go to higher yields. Now, having said that, everyone else seems to think that as well. I mean, I read where one of Bloomberg's tweeters put out today that probably the average for next year for 10 years is between 125 and 150. Yeah, it could be. I mean, I have no reason to dispute that. But the reality is that I think we're going to go to higher rates. We're just not going to go to them between now and the end of the year, in my opinion.
Andrew, one of the things when we talk about the Fed, the recent language that we had from the FOMC and in particular Powell's presser, there was a response to that, again, where bonds rallied and they faded pretty quickly. We lost the Powell rally in about a day. The next day we woke up after Powell's press and bonds were lower and we're still in this channel to the upside. And one of the things I hear a lot is that, well, Powell's going to be here providing liquidity and Powell's going to be here buying X amount of bonds every month, which he is, and that's as good of a backdrop basically as what they were doing in months prior. And in the past of rate cuts and adding more, it seems to me there's a conversation we should be having about kind of the derivative here, the kind of second order, which is whether or not the Fed is applying more to the market, which they're not. So I'm curious what you think about that, because for many people they say, well, Powell right now is the same backdrop as Powell over the past couple years, but I think there's an argument to be made that Powell being steady is not the same as Powell adding on more, as the Fed adding on more. Is that a meaningful change in markets, a Fed that is accommodative but static instead of accommodative and more accommodative?
Oliver, you really hit it on the head, because what you're saying and what you're right, it's not the amount of stimulus that they're adding and the amount of QE that they continue. It's the change, the delta. Are they going to be accelerating their buying? And based on everything I can see right now, no. They really want to figure out how to get out of this mess. In other words, they're going to be here buying 120 billion of treasuries and mortgages for the next decade, and that's not something they want to do. Now, their balance sheet, I didn't look at it at the end of Thursday, but their balance sheet has been steady around 7.2 trillion, and money supply continues to expand at a rapid rate. But I don't see the Fed increasing, and I think the fact, even if they stay static, I don't think it's going to be enough, and I think rates are going to go higher. And I don't think that's a bad thing, because the reality is corporate spreads are tight. Corporate issuers can continue to come. I mean, not between now and the end of the year, but certainly next year there's going to be a great demand for corporates. And I think spreads there have tightened down dramatically. Now, as far as the Fed and their programs, the Fed didn't buy really any corporates. I mean, the last number I saw, they bought 13 billion out of a total of 250 to 275 billion they could have bought. And I see the offerings every day. They're buying 1 million of this, 2 million of that. So I really don't think the Fed wants to gear up in a risk type venue. And I think we have to look at the real risk rate. And I think the Fed's going to be raising rates or allowing the risk-free rate to increase well beyond 2023. In fact, I wouldn't be surprised if we see it happen sometime next year.
Andy, one other thought here just about the stimulus, some of the provisions in terms of what the Fed can do going forward, their emergency lending powers. That line was slipped into the stimulus that both sides were kind of contentious on, but it ended up making it through into the latest version of this bill. Do you think that has an impact on markets, on any of this sort of comfort that the market has had about the monetary side being able to support the system and the situation? Or is this something that the next time we have a stimulus bill around, policymakers will be able to work their way through again? I mean, does this really change anything about how we should view the Fed's role in recovery?
Well, I think the Fed was pretty clear that they're not there in giving away money. They're there in lending. And they really don't want to lose money, even if it's the Treasury's money. So the fact that they took away the 13.3 programs, so that is the Treasury did, whether Yellen gives them back or not, I think is irrelevant. These programs were not being used. I think in the state and local government, I think Illinois tapped it twice, and I think the MTA tapped it twice. And I don't know of anyone else that tapped it, at least not to any significant amount. And I just went over the corporate numbers. So I don't think they really need that. As far as what the Fed can do, yeah, sure, the Treasury can give the Fed more authority. The Fed probably can do things more efficiently than the Treasury can. But I think that the Fed really wants to see fiscal stimulus, and they want to have an independence from the Treasury, of which right now they don't have.